higher gold could be sticking around. That's what renowned precious metal strategist George Milling-Stanley of State Street Global Advisors thinks, and he's not the only one. Before we begin, remember to like this video and subscribe for more economic updates. By now, many investors have become familiar with the significant price durability demonstrated by gold since the end of February. Over the last 8 weeks, gold has increased 13% to slightly more than $2,300 per ounce. At one point during the recent climb, gold managed to top $2,400 per ounce. According to analysts, it has since retreated modestly, in part due to diminished expectations of rate cuts as well as an easing of Middle East tensions. Many investors ask whenever an asset pulls back after upward momentum, what's next? According to George Milling-Stanley, who's had a 50-year career analyzing precious metals, when it comes to gold, it's onward and upward. Milling-Stanley suggested that while he's reluctant to make any long-term price projections, he does think gold has turned a significant corner in terms of its historical price action. For the best part of 10 years now, Milling-Stanley said, any time gold got up close to that $2,000 level, that was a level for the speculators to sell. I think that we've finally managed to get beyond that. We do seem to have established a price solidly above the $2,000 level. It looks to me like we've established a new floor. George Milling-Stanley is optimistic on the near to mid-term prospects of gold for the same reason so many other analysts are bullish on the metal: persistent uncertainty. We still don't know whether the Fed is going to keep rates high enough to push us into recession. Inflation remains sticky. The whole geopolitical environment is increasingly threatening, especially with an ugly, developing presidential election in the U.S. All of those things together, I think that we have a recipe for a decent performance. The strategist also attributes his positive outlook for gold to expectations that demand for the metal among central banks could remain robust. Not only have central banks been net purchasers of gold for the last 15 years, but 2022 and 2023 saw gold demand reach record levels. Net central bank buying has become a solid performer in terms of the demand side of the gold equation. I'm expecting that to continue. It's important to note that George Milling-Stanley does not anticipate the central banks to slow down their gold purchases even with the high prices of gold. I've never known a time when a high gold price acted as any kind of deterrent to buying by central banks. In an interview, George Milling-Stanley pointed out a variety of drivers that could bode very well for gold. What might have been even more impactful is what he said in summary, that gold is a great diversifier, a hedge, and even can offer potential growth. There remains a very solid case for gold. What I like about gold is that historically, the promise of gold for investors has always had a dual nature. Gold can offer you protection against potential weakness in equities, against potential weakness in the dollar, against potential weakness in any other investment asset you care to think about. And gold, over time, not every year, but over time, can help to enhance the returns of a properly balanced portfolio. Anything that offers me protection plus performance is going to get my vote as an asset that I want in my portfolio. As I talk to people who are buying and holding gold and silver, it's a great affirmation to hear experts like George Milling-Stanley state what we are all looking for. We're looking for diversification. We're looking for a hedge, and we're looking for growth. That's why we keep track of gold. And that's why you should keep coming back and learning more.